Control 100K with just $10,000. Double your investment using margin. We've probably heard about margin from all types of people out there. About people being margin called, such as Bill Hwang, who lost $20 billion on a single day, to people who made millions doing margin trading. So what is margin and margin trading? Let's find out. The simplest way to think of margin is a loan. And who is giving you this loan? The broker, where you're making the trades on. So why would you want to get a loan or margin? And that is for leverage. So what is leverage? Leverage is pretty much creating money out of thin air. Well, not exactly per se, but so that you understand the concept of leverage, margin gives you leverage or the ability to control more money than you have. And leverage is shown in ratios, for example, 2-to-1, where for every $1 you put in, you can control $2. So let's say, for example, you put in $5,000 into your account, and the ratio is 2-to-1. You'll be able to control up to $10,000, which would be your buying power, or the amount of funds that you could use to buy securities such as stock. So the higher the ratio, let's say 10-to-1, the more money you would be able to leverage as your buying power. And why do brokers give loans? It's because they make money on the interest. And this interest rate varies from broker to broker, but that's their primary way of making money, is by lending you the money and charging interest on it. So before you could say, wow, this is amazing, and jump into margin trading, leveraging a 10-to-1 ratio, learn to trade with your cash account first. When the stock goes in the direction of your trade, let's say, for example, you bought long and you're expecting it to go up. Yeah, you might make money 10 times as fast on margin, but let's say it goes the other ways. You'll not only lose that money 10 times as fast, you'll still have to owe money back to the broker on that loan, plus the interest rate. So for example, let's say you use $1,000 of your own money to get to control $10,000 in buying power, 10-to-1 ratio. $1,000 your money, $9,000 in loan. The stock goes down 10%. Instead of being down $100, like you would have been if you just put in $1,000, because you did the 10-to-1 leverage, you'd be down $1,000 and own $9,000 back, which has now accrued interest. Sometimes, if the stock is losing value so fast, a broker might make a margin call, requiring you to either pay back the margin to get the account back to a certain percentage requirement as set by the broker, or to sell the stock. And we're saying all of this not to prevent you from doing margin trading, but so that you're aware of the risks and reward if and when you decide to start margin trading. For those who want to manage their risk better and make passive investments that grow on their own, try Doe, which is a Chrome extension that lets you purchase stocks on every website that you shop. Make buying stock as easy as buying something on Amazon. Instead of just spending your money, make it grow. So margin trading has a lot of risk, but there's also a lot of upside potential. At the end of the day, it's your job to be well educated and well informed of what's in it for you, and to ultimately make the decision best for your financial future. With that being said, follow us for more great content regarding personal finance, as well as learning about the markets and figure out what to do during these tumultuous times. See you.